And in our top business story, DP World today has announced a strong set of financial results from its global portfolio for 2015. According to a statement from DP World, revenue grew 16.3% to $3,968 million and adjusted EBITDA increased 21.4%, delivering profit of $883 million, up 30.7%. Commenting on the results, DP World's Group Chairman and CEO Sultan Ahmed bin Sulayem stated that the financial performance has been achieved despite uncertain market conditions and demonstrates the diversified and resilient nature of the company's portfolio of terminals and its focus on high-growth markets. The chairman and CEO further added that in 2015, DP World invested approximately $5.4 billion, with $4 billion in acquisitions and $1.4 billion in capex. Globally, DP World added approximately 3.5 million TEU of new gross capacity and 2.2 million TEU of consolidated capacity during 2015 to take its total gross and consolidated capacity to 79.6 million and 40.1 million TEU respectively. Market conditions in the Middle East, Europe and Africa region softened in the second half of 2015. However, the UAE region delivered another record throughput year with 15.6 million TEU handled. The UAE also delivered a solid performance with containerized revenue growing by 1.8% and non-container revenue by 9.2%. The board of DP World is recommending increasing the dividend by 28% to a total dividend of $249 million or 30 US cents per share to reflect the increase in earnings. More than 22,000 small businesses were established in Dubai last year despite emerging economic headwinds. Dubai SME, part of the Department of Economic Development, estimates that the number of small and medium-sized enterprises jumped by 18% last year compared to 2014. While the weak oil price and strong dollar have hit many companies hard, according to local reports, the chief executive of Dubai SME believes that the current situation was far from a crisis. The number of people opening new businesses in Dubai jumped by 18% year-on-year, although it was not revealed how many SMEs closed over this period. Consumers splashed as much as 10 billion dirhams a month on their credit cards in the UAE last year, with a sharp rise in spending on restaurants and staycations. According to the Dubai-based electronic payments specialist Network International, consumers have been steadily spending between 9 billion dirhams and 10 billion dirhams a month on their UAE-issued credit and debit cards for the past 2 years. Network, which monitors data from the card transactions it processes via more than 18,000 merchants in the UAE in 2015, found that overall spending on plastic in the country grew 9% last year compared with 2014. According to the network data, UAE residents spent 23% more on their cards in cafes and restaurants in 2015 than they did the previous year. Customers with Qatari-issued cards showed the biggest rise in restaurant spending, with a 50% jump over the previous year. Lebanese cardholders displayed the biggest appetite, remaining the highest per-purchase spenders in this category. And UAE cardholders also spent 10% more at hotels inside the UAE on their cards last year than they did in 2014. Visitors from Saudi Arabia increased their spending in UAE hotels by 12%, while card spending from UK visitors increased by 14%. Overall hotel spending was up 4% in 2015 compared with a year earlier, but the amount of money spent per purchase was lower, suggesting that room rates may be falling even though customers are visiting more often. Despite global economic volatility over the past year, investment appetite among UAE high-net-worth individuals does not appear to be dented, with 61% confirming that they would most likely invest in their top target city this year. Clutton's 2016 Middle East Private Capital Survey shows that London, which has historically been an investment magnet for Middle East high-net-worth individuals, has emerged alongside New York as the top investment location outside the Middle East, while Dubai has been identified as the preferred location within the Middle East. The chief executive of Clutton's Middle East stated that the strength of the US dollar, to which the UAE retains a fixed peg, has contributed to the strong appetite for global property investments, particularly in the face of muted local and international economic conditions. While London was just ahead of New York as the most preferred city for investment, the survey shows that New York appears more frequently in investors' top 3 preferred cities for investment in 2016. According to the report, London has been an investment destination for Gulf buyers for many years, a trend which is expected to continue, with growth of average residential property prices expected to reach the 2.5% to 3% mark for prime central London as a whole in 2016. Clutton's data also shows that whilst residential property remains the most attractive investment asset for UAE's high net worth individuals, interest in commercial property continues to remain strong, with 22% of those surveyed indicating a preference for offices as an investment class.